Hi everyone, and thank you so much for joining ABGF's Growth Capital webinar. It's really wonderful to see so many people registering for our webinar. Hello. Oh great, we've got everyone coming in now.
We'll go to the mediation as per the agreement. And we'll resolve
Hi everyone.
one way or another.
Hello. Very good.
Thanks so much for joining.
That sounds good.
I think everyone's just being turned on mute so we can all hear each other properly. It's really great to see so many people registering for our webinar and joining us today. ABGF runs these webinars periodically, and I think today we actually had the highest number of registrations that we've seen to date, which is great. But I think that means we're going to have people trickling in for a few more minutes. So maybe just while we're waiting for all the attendees to join, I might just give a quick recap of why we're here. Now, for context, we're the Australian Business Growth Fund, and we'll tell you more about who we are shortly. And we're running this webinar for anyone in the community, be they business owners, advisors, or other investors, to learn more about what we do and how we invest and about growth capital more generally. So hopefully we've got enough of a critical mass here now. So I might just start moving through the slides and kick off by just introducing the speakers from ABGF today. So first off, we have Anthony Healy, who's ABGF's founding CEO and Managing Director. Anthony previously worked at NAB as Chief Customer Officer prior to leaving banking to found ABGF. And prior to NAB, he held a number of roles across the banking sector, including as CEO of Bank of New Zealand and Head of Business Banking at ANZ. And we're also joined by Patrick Verlaine, who is one of ABGF's 2 co-heads of investment. And prior to joining ABGF, Patrick was a partner at mid-market private equity fund Crescent Capital. And then you've got me. I'm an investment director at ABGF. And also Tim Hayden, who's ABGF's origination director. So you'll hear more from all of us shortly, but before we kind of kick off formally, I'll just give you a brief overview of what we're going to be talking about today. So the key topics we'll cover, firstly, we'll give you an introduction to ABGF, including who we are, our background and our purpose. And then we'll talk more generally about growth capital, including how it's different from other forms of equity capital, such as venture capital or buyout private equity. We'll then talk about what it means to partner with, by which we mean receive investment from ABGF, including our investment process and how we value a business when investing. And then we'll talk about how our investment model can give shareholders liquidity to help them de-risk. Finally, we'll share a case study of a business in our portfolio, and then there will be around 10 minutes for Q&A at the end. So just some housekeeping before we kick off. If you do have any questions throughout the presentation, please just, you can drop your questions into the chat function on Teams at any time. You will be muted throughout the presentation just to keep things moving smoothly. But then at the end of the session, when we do start Q&A, feel free to also raise your hand using the Teams function, and we'll unmute you, and you can ask, or you can unmute yourself and ask a question. So that's how we'll run the Q&A. So please just either drop your questions in the chat or keep your questions for then. With that, I think I'll hand over to Anthony to get us started.
All right, thank you, Lucy, and welcome everyone on the call. I'm just taking you through the background to the fund. So the Australian Business Growth Fund was founded in 2020. I think a recognition from all of the shareholders that you can see below there that there was a gap in the market for long-term patient minority growth capital for SMEs. We are Australia's only purpose-built growth capital fund that is dedicated to SMEs. We're a public-private partnership. As you can see from the bottom, we have the major banks and the Australian government as shareholders. We raised $540 million initially from those 7 shareholders to invest in SMEs. I should emphasise that whilst we've got all of those shareholders, the investment decisions are made independently of all the shareholders. They're made by the investment committee, which I chair. As I mentioned earlier, it's patient minority growth capital. So We're always minority, and so we're not in control, but we're there to support the founder to realise their growth ambitions. The objectives, of course, are to support the sector, to drive economic growth and create jobs, and to support Australia's entrepreneurial ecosystem. So just next slide, please. Just where we fit in the kind of capital stack. We sit in between buyout funds and venture capital. So if you're a startup, early stage, smaller check size, then venture capital is the sort of most logical place where you'll source funds. If you're a more established business, particularly if you're a larger established business and you're prepared to give up control, i.e. a buyout, then there are large and mid-market buyout funds that will take control of the business, take more than 50%. And we'll talk through later why that might be a decision you want to think about as to whether you want to give up control now or later, and where the upside might be for you now versus later. But for us, we sit square between venture capital and buyout. So because we're minority, we have a longer term investment horizon because, of course, we don't control the exit pathway. That's up to the founder. The check size is typically in that range of 5 to 15 million. And so there's not a lot of institutional investment capital in this space. And we look for businesses that have a demonstrated track record of profitability and growth, but obviously with real growth aspirations and ambitions that we can support with capital and expertise. So I think in terms of the kind of specific criteria, I'm going to hand to Tim, our head of origination, who can step you through that.
Thanks a lot, Anthony. So yeah, as Anthony's highlighted, we can support businesses in a range of different situations, but on the page and here is just a few of the sort of key criteria that we look for when we're assessing a business. So first of all, Australian headquartered businesses. We look at businesses with up to 100 million in revenue and also have a track record of profitability. One of the other aspects we really look for in a business is their unique value proposition. And what this means for us is not necessarily that the business needs to have a one-of-the-kind product that has been developed to revolutionize an industry. Unique value proposition for us is really about a business that has demonstrated a track record of looking after their customers with a differentiated proposition to their competitors that's sustainable and can last the test of time. We also look for significant growth potential in the businesses that we look at. And really this refers to the capacity of a business to significantly expand its operations and its revenue base. This can be achieved through a number of means, whether that's entering new markets, whether it's interstate expansion or offshore expansion, the introduction of new products or capabilities to the business. It can be done through acquiring a competitor, or also other organic growth initiatives like hiring new staff members, further pushing business development within a business, and a range of different other ways to organically grow the revenue base of the business. And last point to note is, as Anthony's highlighted, we're a minority investor. We're really keen to partner with founders that are looking for our assistance with their growth, and we'll talk to a little bit of that later. It's not just about the capital investment into the business itself. A couple of areas which you'll see along the bottom of the page which we can't invest in. So to call out a few of these, APRA-regulated businesses, distressed investments, listed businesses, and natural resources extraction is another one. So I might ask to move to the next page just to highlight a couple of the situations that are typical for where we invest. So we can invest into the business in order to accelerate the growth of the business, whether that's to automate a manufacturing facility, explore new product development, fund working capital. So the more traditional sort of primary growth capital into the business type situations. We can also explore, money off the table for founders that have perhaps owned the business for, a long period of time and are looking to de-risk a bit of their personal wealth that sits within the business. Similarly with that, we see a number of situations where business owners have owned the business for a large period of time and want assistance with succession within the business. They still want to retain control, but ultimately, our investment, whether that's to purchase shares in the business, is about facilitating and supporting the business in that process. And Patrick will talk a little bit more about that later with a case study. And then just one other to call out is, and a really common use of our capital is funding the mergers and acquisitions of companies that are looking to acquire smaller competitors or merger of an equal competitor within their industry. So I might move just to the next slide, which with Anthony's covered a number of these points, but just to call out how we invest. So it's a minority equity stake, so leaving the founders in control. The check size itself is $5 to $15 million, with the ability to follow on with further investments of up to $30 million whilst remaining in a minority position. The approach to how we invest, and we'll talk a bit more about this in a case study, but it really is a hands-on and an active approach where the team that we've built out at ABGF is really focused on supporting the business through all of the strains and inflection points that come with growing quickly. The other point and final point to note is, our investment horizon is flexible. There's no hard deadlines, and we work really closely right at the outset of exploring a transaction with a founder to discuss what exit might look like and an appropriate time frame for that. So I might hand over, I think, to Patrick, to Lucy to talk through a little bit about how we value a business.
Thanks, Tim. So I've just got a couple of slides now on how we go about valuing businesses. And I know we have a number of advisors in the audience, so apologies if I'm covering information that you know already, but I think this is something that's very important for businesses to understand, and it's certainly something that a lot of businesses ask us about. And the main principle is that we value businesses by coming up with an enterprise value, which is calculated by multiplying an earnings metric, which is usually EBITDA, but sometimes other metrics can get used. And we multiply that earnings metric by an earnings multiple, which, if you're using EBITDA, would be an EBITDA multiple. And I'll spend some time talking about the earnings metric on the next slide. But first, I want to give you more detail on how we come up with the earnings multiple, because it's a key driver in valuation. And it's something that I think a lot of business owners often like to understand more about, how we actually come up with that number. So the earnings multiple, which, as I said, it's generally an EBITDA multiple, is driven by a number of different factors that essentially reflect the attractiveness of a business to an investor. So first off, there are a range of factors that we consider relating to the market and industry that a company operates in. So, for example, the size of the market. We look at whether the market is large, which means that it might be easier for the company to grow and take market share, or if the market is relatively small, which might indicate that a company has very limited room to grow before it taps out the available market size. We'll also look at the speed of growth of the market. So is the market growing at quite a quick growth rate, which indicates that there are pretty strong tides that will help the business grow as well? Or is the business growing more slowly? So, for example, just at CPI, which will indicate that it'll be more challenging for the business to pick up its growth rate. We'll also look at barriers to entry in the market. So, for example, how easy it is for new competitors to enter the market. And we'll look at how the industry is structured, which might include understanding specific regulations or competitive dynamics that affect the industry. For example, whether the industry is highly competitive or if it's more of a monopoly. Then we'll also look at a range of factors that relate to the business itself, including the business profile. So firstly, how profitable is the business? And we look both at the dollar value of profitability, with businesses with higher earnings generally attracting a higher EBITDA multiple. And then we'll also look at the profit margins of the business. So kind of what kind of gross and profit margins are they able to attract? Then we look at the quality of earnings of the business. So do they have a high amount, for example, of repeat revenue, or alternatively, do they have a high amount of customer churn? Then we'll also look at capital intensity, how much is required to be spent by the business every year on maintenance capex, just for business as usual, and how much do they need to spend in order to grow. We'll also look at things like the quality of the management team, and then specific risks relating to the business, like regulatory or macroeconomic risks. So putting this all together, you can see in the chart on the right-hand side that different industries typically trade at different multiples. For example, software, which is the highest line in black on the right, generally trades at a much higher multiple, so generally double-digit EBITDA multiples. And that's due to the size and growth rate that you generally see in software markets, the low capital intensity of software businesses, and the high gross and profit margins that software businesses typically operate with, and generally a lot of repeat revenue, recurring revenue also occurring in software businesses. On the bottom end of the chart, you'll see in purple, we've got industrials type businesses, and these generally trade at lower multiples, maybe mid single digits or high single digits if they're particularly large. And that's just due to the higher capital intensity of these kinds of businesses and generally lower growth rates, slower growth rates across these markets. And we've got healthcare businesses just in between there. And you'll see from this chart that EBITDA multiples increase as EBITDA increases and businesses get larger. But then also within each band that we observe for businesses, in a certain sector, that there will be specific companies that can command a premium or a discount to these average market multiples, depending on their unique characteristics, as I said above. So things like the specific suppliers or customers in the business, the management team, the specific profitability metrics of the company. So just translating this into an example, we've got here as an example how we would go about valuing a manufacturing business. And so as I said before, you take an earnings metric and you multiply that by an earnings multiple. And so I'll just break down the earnings metric in a little bit more detail. And as I said before, usually we do value a business on the basis of EBITDA, but there will be some instances where we may consider EBIT, for example, where a business is very capital intensive. And so you want to look at EBIT, so you want to kind of factor in the depreciation and amortization kind of costs of maintenance capex that a business requires when coming up with your valuation. And so that is an approach that we might consider for a manufacturing business, since businesses in this sector are typically pretty capital intensive. However, in this specific example for this specific company, we did use an EBITDA multiple because of the long life cycle of the equipment used and the relatively low maintenance capex, which got us comfortable that EBITDA was a relatively strong proxy for cash flow. Then the next question when it comes to coming up with the earnings metric is what time period you're using for that earnings metric. And we'll always look at that earnings metric, so here EBITDA, over a 12-month period, but that could be EBITDA for the last financial year, or it could be EBITDA for the last 12 months, or if we have very strong visibility over future revenues and contracts, for example, we might use forecast EBITDA. And in this specific example, we were comfortable using a forecast EBITDA multiple since we had 9 months of actuals. And we had certainty over the forecast 3 months of earnings. So in this instance here, it's FY24 because we were still in the FY24 financial year. We used an FY24 forecast multiple, but that will generally be a discussion with a company that requires us to understand the nature of their revenues, to understand whether it's reasonable to use a forecast multiple. The last question we have around earnings metrics is whether you use reported EBITDA, so no changes to the reported figure, or an adjusted number that accounts for some one-off items. And in this specific example, we applied some adjustments to EBITDA to reflect sales that had been lost as a result of one-off incidents. And so we came up with a pro forma EBITDA number that we used for the valuation. Then moving over onto the earnings multiple. So the way we went around coming up with this and looking at what companies in similar areas of this manufacturing kind of sector trade for, we always start off by looking at trading and transaction comps. So trading comps being comparable companies that are trading on the ASX or other listed exchanges internationally. And then we also look at transaction comps, so recent comparable transactions in the industry, which we typically segment into large and small transactions. and we'll always have a bias towards transactions that are similar in size to the business that we're looking at. So in this case, because we were looking at a smaller business, we focused on smaller trading and transaction comps, and we came up with a broad range that took us from 5 times EBITDA on the low end to 10 times on the upper end. And then to narrow down that range, we will focus more on the companies, on the comps that are most similar to our business, which is how we get from a larger range down to a more specific and precise multiple. So hopefully that gives you a bit of an overview of what our valuation process looks like. And now, having covered off valuation, I'm now just going to switch gears and talk a bit about ABGF's investment process. And in keeping with the nature of our fund, as Anthony mentioned earlier, as Australia's only fund that was purpose-built for SMEs, we've designed an investment process that is very specifically suited to SME businesses and really keeps in mind often the resource constraints that smaller to medium-sized businesses have, which makes it harder when they're fielding a lot of information requests from investors and long investment timeframes. So our process from end to end can take as little as 10 weeks from the first meeting to the date that we fund. And we have completed investments in that timeframe. But equally, this timeframe is always driven by the business that we're working with and how fast or how slow they want to move and the quality of information they have available. And often companies do need to spend a bit of time getting information together before they're ready to engage with us and really start the investment process. So in terms of what our process looks like week by week, looking first at weeks 1 to 4, during this time frame, we are generally working towards receiving our first investment committee approval. And that approval is what allows us to sign a term sheet with a company that summarises, all the key aspects of the deal, including price and our main investment terms. So to get to that first investment committee approval, we generally start by holding a lot of meetings with the management team. We'll always kick off with a couple of meetings just to get to know the business, get to know each other, and learn more about the business and its industry. And then we'll start our preliminary in-house due diligence. So that's due diligence that we do only with our team in-house. And we'll look at things like the market opportunity and the size of the market. We'll look at the company and its competitive differentiation, how it's placed in the market relative to competitors. We'll look at its business model, the strengths and weaknesses of its business model, how it earns revenue, the nature of its customers. And then we'll do a financial analysis, looking usually at the last 3 years of financial performance and any forecast of financial information that the company has available, whether it's just a 1-year budget or a 5-year plan. And then we'll use that as well to try and understand the growth opportunities available to the business, whether it's M&A or new market entry or new products. And then we'll also spend a lot of time making sure we understand the requirement for capital and the uses of funds that the business is asking for. So that's roughly our first month of work. And then following that first IC approval, the next 4 weeks we spend in final confirmatory due diligence. And for this phase of DD, we generally bring in external advisors just to do confirmatory financial, tax and legal DD. And again, mindful of the small to medium-sized businesses that we're investing in and their resources and time, we try and keep these external advisors and their remit as tight as possible. And so we really do try and make this process happen within 3 to 4 weeks max. And during this time frame as well, we'll continue our own commercial DD. That usually involves site visits if we haven't, visited the company or its sites previously. And we'll often also do select customer or partner interviews just to make sure we really understand the key relationships that the business has. Now, around this time as well, we typically start negotiating legal documents in the background based on the term sheet that we've agreed. And all this work takes us to our second and final investment committee approval, which is where we get approval to present final investment terms and enter into the legal documentation. So once we have that approval, then we generally just finish negotiating the legal documentation, at which point we're ready to fund and complete the investment. So as I said, definitely possible to get it done in 10 weeks, but it can be longer or even shorter depending on the readiness of the business to transact. And so with that, I'll now hand over to Patrick.
Thanks, Lucy. So I'm just going to take you through a couple of liquidity options and the financial impacts of both of those and how they could relate to you as a founder in your next steps. So the first one we're seeing on the page here is a full sell down. So as the name implies, that's selling 100% of the shares in the business. So again, applying the methodology that Lucy outlined earlier, it's a hypothetical situation where you've got a business with an EBITDA of 7 million. And let's just say that it achieves a valuation multiple of 5, so an EBITDA multiple of 5. So 7 times 5 is 35, which is the enterprise value. You then got to subtract the net debt, which again hypothetically is 5 in this case, to give you an equity value of $30 million. Now, if you were a sole shareholder and you were to sell down 100% of your shares, you would then get $30 million in your pocket. In that transaction. Now, the benefits of that is obviously you're maximizing immediate liquidity. That allows you to pursue life goals, to buy a boat, to sell off in the sunset, or travel or whatnot. The downside, of course, is that you're giving up the future potential gains there and then by through that liquidity event up front, and you're unlikely to maximize the short-term value of the business. Another thing worth keeping in mind is that it's quite rare for founders to be able to sell out 100% of their businesses up front. Usually the acquirer will request the founder to either sort of have an earn-out or will lock up their equity or need to roll 20 or 30% of the equity for a few years. So again, this hypothetical situation, but often it's pretty hard to achieve 100% sell down up front. If we move to the next scenario, which is a partial sell down, you can see on the left-hand side, it's the same chart as we had before. So $30 million equity value, so exactly the same business, exactly the same multiple. Let's say as a sole founder or shareholder, you decide that actually you think there's a lot of potential in the business. You're not ready to let go entirely yet. You think there's a lot of growth. But equally, you don't want all your eggs in one basket. You want to de-risk a little bit. So you try and find a financial investor such as yourselves, a minority investor in this case, and you sell down a third of your business. So 33% of your shares. So in this case, that's $10 million. So that's $10 million that you take off the table. And that's $10 million in shares that we acquire off you if ABGF were to invest in that business. So you still retain 66% of the equity. Now, let's say you then decide to grow that business, and we would do that combined, obviously, across a joint strategy, which would be agreed beforehand. And again, hypothetically, let's say you double the size of the business over a 5-year period. So you've gone from a $7 million EBITDA to a $14 million EBITDA. Now you've got a business that's twice as big, that's twice as robust, broader systems, products, etc. So that should attract a higher multiple. So again, theoretically, we're going from multiple of 5 to multiple of 6. So 6 times the 14 gives you an enterprise value now of 84. Assuming the same net debt number as in the prior scenario, you end up with an equity value of 79. So you've now more than doubled over 2.5 times the equity value from 30 to 79. So that 66% share that you've got left in the business would convert into $53 million, so 66% of 79, which you've got to add on to obviously the initial 10 million you took out. So now you've converted, I guess, your initial 30 million of equity into $63 million of equity. So you've more than doubled the money that you're taking off the table as a result. Clearly, that would deliver a return to ABGF as well. So you can see how in a scenario by holding on more, by taking on an experienced investor who's helping you execute on a strategic growth plan, which has been pre-agreed up front, you can certainly maximize the value that you're deriving from the business while still maintaining control. And that's really the upside. I think the key value proposition of an investor such as ABGF is a minority investor who will help you find the right talent, who will help you devise the strategy and then execute on the strategy to ultimately grow the business and deliver more value to you in a staged approach. I thought I'd just spend a bit of time covering our portfolio. We've discussed how ABGF is industry agnostic. You can see our current portfolio here. There's 12 businesses, and hopefully it's quite evident from the page around how diverse the portfolio is. So we will happily look at most industries. There's a good few examples here. I'll just talk through a few. If you look at 3ME on the top left of the page, it's an off-highway and heavy-duty electrification business. Essentially, 3Me tries to electrify mining and defense vehicles, which is a pretty exciting and challenging space to be in. To the right of that, you have CLS, which is a commercial laundry operating in regional Queensland. There we're helping the business open a brand new facility and try and consolidate the market and broaden their management capabilities at the same time. Derwent Industries is a diversified industrial group, which is a manufacturer of metal and rubber products, servicing the water, mining, and defense industries, amongst others. DIY Blinds is an e-commerce business selling B2C home furnishings online. Evolution Trustee is a financial services business. It's a corporate trustee business, offering effectively corporate trustee services to large corporates. HMC and aviation tourism business. InSkin Cosmetics, that's a B2B cosmetic business selling to beauty parlors and whatnot. Solbari on the bottom is a B2C sun protective apparel business. You have Kikeda, which is a medical business, which is a dental business, an aggregation of dental clinics. And then Total Green Recycling on the bottom right, which is an electronic waste recycling business based in WA. So you can see how we're quite happy to invest across software, across healthcare, across industrials, across technology, to really try and cover the full universe of SMEs in Australia. Worth spending a bit of time talking about one of our latest investments called Modra Technology. I think Modra is a real, I guess, highlight and success story for Australian manufacturing and innovation. Modra is quite a small family-owned business based in Warragul in regional Victoria. And what they've done is actually developed this robotics technology to help reduce the costs of carpet manufacturers around the world. This technology is patented, they distribute it worldwide, and they're a global leader in the space. The business has about 200 customers across 35 countries, and has spent a lot of time and effort in the R&D to actually develop this product. So we're approached by the founder and the family, and it's really, I guess, a perfect example of what I just talked through earlier, which is a partial sell down, where the founder wanted to de-risk somewhat, had all his wealth in the business, and whilst he was very confident in the business, he wanted to actually enjoy life a little bit more and de-risk a little bit. But importantly, he really wanted to help of growing the business. He wanted the governance that institutional investors such as ourselves could bring on board, because he understood the potential of the business, but couldn't actually execute that himself. So we were in discussions with Tim over a few months, agreed a valuation, and in that process, Tim took some money off the table, and we also agreed basically a growth strategy of the business, and that growth strategy was around basically investing more in R&D, because they had done that so successfully initially, but we thought actually more capability and resources could be invested in that. And there's also a parallel strategy around de-risking the current business, because a lot of its revenue is reliant on a single product. So basically it's putting more resources into R&D to try and develop a second or third product. Another key point was around facilitating succession planning for the founder himself. As I said earlier, it's quite hard to actually sell 100% of your business upfront. Most acquirers will want the founder, and the founder in this case is the CEO, will want them to stay behind for usually a few years and typically roll some equity. So Tim Modra understood this very well and understood that the only way that he's going to be able to fully extricate himself from the business at a later stage is by him stepping back as CEO and introducing a professional CEO at the right point in time. So this is again something that we will facilitate and help Tim with that process in terms of that selection criteria, the interviewing process, and actually developing the CEO to move into that position successfully. And I'd say the last lever on the growth plan is really expanding the management capability and the capacity of the plant to expand overseas and to maximize volume essentially. So we agreed all that up front with the founder, executed on the transaction, and now we're in the process really of executing on that strategy and enabling those three levers. So in this case, I'm sitting on the board. We've also attracted a very competent non-executive chairman to help us on that expansion plan. And we're in the process of essentially finding a new CEO, a professional CEO, which will help the founder in this case progressively over a few years step back to a non-executive position, so that when the time comes to fully exit, hopefully in about 5 years' time, him being involved in the business will no longer be, I guess, a critical path, given there's professional management team around. So I think that's all I was going to say on Modra. I might hand over to Tim to go through some Q&A. I think you're on mute, Tim.
Thanks, Patrick.